Good morning, everyone. This is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, September 23rd, 2024. As we previewed last week, the big event last week, economically speaking, was the Federal Reserve's decision to cut their interest rate by 50 basis points. So there was a question we knew they were going to cut, question of whether it was 25 or 50. We were leaning towards the 25 side only because the economic data looks pretty strong. So we'll go through some of the metrics that were released last week, but just in total, U.S. economy looks pretty strong, and we just got a tailwind of 50 basis point cut by the Federal Reserve. So last week, in terms of economic data, retail sales ex-auto, both better than expected. Both of those metrics for the month of August came in at a positive 1% month over month. Much better than expected. And on Wednesday, we had building permits, housing starts, same thing. Both came in better than expected. On Thursday, we had initial jobless claims, far lower than expected. 230,000 was a consensus, came in at 219,000. So the only metric last week that missed consensus was existing home sales very slightly. Expectation was 3.9 million. It came 40,000 under that. So economic data last week, very solid. The economy looks pretty strong. So again, 50 basis point cut looked a little much to us. So how is the economy doing? Here we are near the end of the third quarter. We always look at the Atlanta Federal Reserve and their expectation for GDP growth during a given quarter. They are at 2.9% for the third quarter. That would be a very strong reading for an economy our size with a run rate of 2.0. Potential run rate. So it looks like another strong quarter of GDP growth here in the U.S. Now, one thing that the rate cut did do last week was push up inflation expectations. So again, we're not at the Federal Reserve stated target PCE, personal consumption expenditure, inflation level of 2.0. So the announcement last week did push up inflation expectations. So the 10-year break even now is implying 2.15% inflation over the next 10 years. That's up 7 basis points from the prior week. So it's not horrendous, but directionally, certainly the markets did. That's the inflation reaction to the Fed's decision. Now, in terms of what the Federal Reserve might do going forward, next meeting, November 7th, will be the rate announcement. And the expectation now is almost 47% probability of another 50 basis point cut. So 53% expectation of only one. But definitely a cut is coming, another cut, possibly two here in November. By the end of the year, the odds of at least 3 total, so we just got 2. Odds of another 3, 74%. And that odds is up from 62% the prior week. So let's take a look at how the markets reacted to the news, to the Fed cut. Not surprisingly, equities were up last week. So nice rebound in equities after the Fed announcement. So in total, S&P 500 last week up 1.4%. And now for the year, S&P 500 is up 20.5%. So beneath that, the headline number, the S&P up, the equal weighted S&P, same 1.35%. So we had decent breadth, but where it really came in was on the small cap side. So small caps last week up 2.4%. That's sort of what you would expect directionally with interest rate cuts. So it does favor small cap companies more than large. Both small and large cap companies have about the same percentage of debt on their books. However, the percentage of floating rate debt that benefits from rate decreases is far higher for small cap companies. So not surprisingly, again, small cap rallied up 2.4% last week. In terms of international markets, developed markets ex-US, also positive last week, up 0.5%. Emerging market was really the big winner last week, up 2.23%, and 30% of that index is made up of China. China equities last week up 4.6%. Now, the Bloomberg U.S. Aggregate Bond Index last week was actually down slightly, down 22 basis points. You had the 2-year yield up 2 basis points, The 10-year was actually up 9 basis points. So we'll just go through the year-to-date numbers again. The S&P 500 up 20.8%. You've got the developed world ex-US up 8.5%. Emerging markets up 8%. And you have the Bloomberg US Aggregate Bond Index now on a year-to-date basis up 4.7%. Okay, so the economic activity coming out this week post the Fed Reserve numbers. We'll just go through them really quickly. Calendar-wise, new home sales coming out on Wednesday. The expectation is going to be a little worse than it was a month before. September or August is expected to come in 700,000. Month before it was 739. Durable goods orders actually expected to go down month over month. Now it was really strong in the month of July. Month of August is expected to drop negative 2.6% month over month. But that same metric, durable goods, but ex-transportation, that's actually expected to be up month over month by 0.1. Initial jobless claims, which came in at 219,000 last week, that's expected to be worse as well, slightly. Expected to come in at 225,000. Now on Friday, this is the big number, 3 big numbers. So you have the PCE, again, personal consumption expenditure. This is what the Fed watches. It's their primary metric for inflation. Personal income, personal spending, all 3 of those, technically 4, are coming out on Friday. So for the PCE index, the headline number is expected to be up only 0.1% month over month. And for the month of July, that was up 0.2, so some further improvement there. The core PCE number is expected to be flat month over month, 0.2%, positive 0.2%, same as it was in July. Personal income is expected to ramp up a little bit. So the month of July, it was up 0.3%. It's expected to come in at 0.4% positive for the month of August. And lastly, personal spending is actually expected to back off a little bit. Month of July, that was up a positive 0.5% month over month. That's expected to come in at a positive 0.3% month over month. So that's it for this week's update. Thank you very much for attending. We appreciate it and hope to see you again next week. Thank you.